In the first video this week, you took a look at developing recommendations, which was CFP Board's domain 4. In that lesson, we explored how you will be looking at alternative strategies and products within the context of the client's goals, their risk tolerances, their needs and constraints. In this lesson, you'll review many of the strategies that you learned in your core courses, those strategies and products which you'll be building into your recommendations for your client. Note that our review is not comprehensive. You want to go back and take a look at the extensive notes that you developed in your courses. But this gives an adequate overview. We'll start with the strategies of cash and debt management, because as we're developing recommendations, we need to always think about how our clients will fund these recommendations, whether that's the ability to fund now, over a period of time, or perhaps a delayed implementation funding in the future. From a macro perspective, the strategy to improve cash flow is relatively simple. We could say if we can increase the cash inflows, decrease the cash outflows, that will drop more dollars that can be systematically used for improving the current plan or for adding to savings. Some of the strategies you might think about for increasing your client's cash flows could be increased earnings. And that could be the wage earner receiving bonuses, working overtime, perhaps moving to a new job that pays better for their skill sets, or perhaps even the non-working spouse going back to work to increase the family income. It could also involve cultivating new income sources, such as a new part-time job, perhaps developing consulting work, starting a for-profit hobby business, even renting out a room in a house, or perhaps initiating a reverse mortgage. For passive income, could be repositioning investments for greater cash flow, such as moving from growth stocks to dividend income stocks, having an annuity that immediately starts paying out. A good place in your analysis, I think, to start is to look at the liability side of the statement of net worth. What is the balance and cost of the credit card debts? What's the balance and cost of the home and auto loans, the home mortgage and the auto loans? This can give you a lot of information about some possible strategies for reducing the liability cash outflows. Some of the strategies you might think about in improving your overall client cash flow situation and by decreasing the cash flows would be to rethink the annual budget. And this is a discussion you'll have to have with the client. A couple of the areas which tend to be wonderful areas to improve cash flow is managing variable and discretionary expenditures. You'll need to point that out to your client. Have that conversation with the client. Where can you cut back? Vacation spending, discretionary spending, those conversations. Linking those savings to better use of which will help the client move towards their goals. Clearly, in this environment, there might be the possibility of refinancing mortgages at historically low rates. Now, of course, there's been a lot of shrinkage in equity, so you have to take a look at that's even available. But refinancing mortgages and also consolidating debt with lower costs debt payment, and possibly even debt that can be tax deductible, at least the interest piece of it. So consolidating high costs of credit cards, perhaps even auto loans with tax deductible home equity mortgages or home equity loans. If there's the ability to shift personal expenses, which tend to either be below the line items or non-tax deductible items to the business, that could be a wonderful benefit in improving cash flow situations. Some strategies such as qualifying for insurance policy discounts because all or most of the family's insurance policies are purchased through one provider, and taking a look at ways of minimizing tax liabilities, a subject that we'll take a look at in the next video. Let's take a few moments and walk through refinancing, perhaps as a refresher from one of your, maybe you saw this in 591, 593. Given a situation where the client purchased a home 14 years ago, the original loan amount was $384,000. It's a 30-year loan, so 14 years ago, so there's 16 years remaining, right? And the cost of the mortgage was an 8.4% APR. Does it make sense to refinance with a 15-year, 5.8% mortgage in which there's points for refinancing, 2 points? First thing you need to do, if you do not already know the current monthly payment on that 30-year loan. Since this is fully amortized, we can do this very quickly on our financial calculators. So you can see we have 30 years, 12 periods per year. So the N is 360. The monthly interest would be 8.4 divided by 12. The PV, and that was the amount of the original loan, was $384,000. Since it's amortized, the fair market, the future value will be zero. Solving for that payment, we see it's $2,925.46. The second step is to calculate the balance remaining. Remember, you're 14 years into this loan. What is the principal balance at that point in time? As you can see here, I calculate $308,417. The keystrokes that I enter here are for the HP12C. You'll want to refer to your calculator's manual or go online to get your calculator's manual so that you can follow the correct process to get to that correct loan balance or the current loan balance. In that case, we need to now find out what is going to be the monthly principal and interest payment of the new loan. Given that you're taking out a loan now of $308,407 plus 2 points, and that's why you see I'm multiplying that amount by 102%. So the new loan will be $314,585. Again, this is a 15-year loan, 12 periods per year, so that's 180 is the N. The I is 5.8, that's the APR, but we need to get the monthly, so that's divided by 12. The PV is the $314,585. Again, the future value is zero. This is a fully amortized loan. And solving for the payment, I get $2,620.78. This could be a very effective presentation to your client in showing them the savings. In this case, I'm showing that the current loan, as calculated, has a monthly payment of $2,925.46. The new loan would have a monthly principal and interest payment of $2,620.78, and that's a monthly savings of $304.68. That would be impressive to your client. Maybe even more impressive is to see what is the total savings over the term of the loan. Now, the cost of the current loan still is 16 years, so that's 16 times 12 months times the 2925.46 means there's a remaining cost of $461,688.32. The cost of the new loan, again, now that was a lower monthly amount, $2,620.78. In this case, there's 15 years and, of course, 12 periods per year. Comes out to $471,740.40 for a net savings total dollars over the period of $89,947.92. You can see how these numbers would be very motivating to your client. With the $304 of monthly savings, we're looking at in the area of what, around $3,600, $3,700 per year in savings with this loan per year. Another idea to think about in the area of cash and debt management is building more liquidity and flexibility, access to liquidity. Some of the ways you might think about some of the strategies and products or lines of credit with a bank. Now, it's particularly important that a line of credit be set up before retirement because banks are very, very reluctant to hand out lines of credit to retirees that don't have income sources, even though there might be some passive income sources there. So you want to get that in place before retirement. Certainly accumulating emergency funds, a subject you studied in Business 501, Introduction to Financial Planning. And as you learn there, you're looking, in that 3 to 6 month range. Where you are in there depends upon the situation. Is one spouse working or two spouses working? How easy it is to get back in the workforce, that sort of thing. The cash value of life insurance and loans from qualified plans both add flexibility into your plan. Your client could tap that cash value if needed. They could then also access some of the money in those qualified plans. The Roth IRA is another source of liquidity flexibility in the sense that once it's been in place for 5 years, withdrawals from the Roth are return of principal first. And finally, there might be some things you can do to help your client with their credit scores because the cost of debt is linked to credit scores. Well, if you're working with a client that has poor credit ratings, there are some recommendations you can make to help them build that back up. And you have to note, first of all, that it's going to take time to fix a low score. Trying to manipulate scores by closing credit cards or taking out more credit cards doesn't really work. I think 4 of the tactics that you'll be using or recommending to your client is for them to start making their credit payments on time, maybe even setting up payment reminders so that they are making those on time. They need to commit to paying down the debt, perhaps some strategies you can work with them to help them pay down that debt. And if there's any incorrect data on the credit reports, that should be reported and cleaned up because that can help things. Debt isn't a bad word, especially when it's used for, or it's controlled use of debt. When it's used for temporary situations or used to fund assets which you expect to grow over time. Now, 2 sources of debt which was available to your clients are the closed-end or installment loans. Examples of those are home mortgage, the home equity loan, auto loans, student education loans, personal loans. And characteristics of installment loans is that there's going to be a contract, there's going to be repayment terms. The number of payments, the amount of the payment, the due date, the stated rate of interest. Revolving credit, also known as open-end, in other words, it's there when you need it as long as the account is in good standing, includes items like credit cards, store charge cards, overdraft protection, home equity lines of credit, revolving check credit at a bank. You need to be careful with this, obviously, because these costs are typically a lot higher. But again, they might be a strategy that's needed in a pinch. In this presentation, we took a look at some of those cash and debt management strategies that you might be using in helping your client implement their plan to pay for some of your plan recommendations. In the next video, we'll take a look at income tax planning strategies and insurance planning strategy.